S&P had 3 amazing days, one of the best weeks we had of the year. It is somewhat concerning. I'm going to explain why in a moment here. I don't really like the fact that we couldn't undercut, that we got there and bounced. To me, it's too much of a technical bounce. If you look at this on the weekly, this kind of encapsulation without undercut usually tends to be a problem. What I'd like to see is I'd like to see these undercuts, and then after those undercuts, those rallies are what you want to see. I don't like that you got up to the top of here and you're rejecting over and over and over again. I do like that you're doing this going into the event that we're heading into, but there's some key issues here. If you take a look at the cues, all you're doing is forming an A. Nothing's really changed here. Let's get rid of that line. What's really changed here? You're down, you tried to rally, and you failed. If we take a look at this and just mark it off, there's some real, in my opinion, there's some real issues here. But you know what, we'll do it. Let's do it this way and then come back to that in a second. But if we just drop these fib levels here, what did you do? You just bounced to a fib level. So should I be giddy? Should I get all excited? Probably not, right? You probably want to watch this level and pay attention and say, okay, are we going higher? Are we not? And the reason for that I say that is that when you start looking at some of these names like the NVIDIAs of the world and just start laying over like the most simplest of indicators, there's your 55. And people will say, well, you're above it. Well, are you? Kind of. You're kind of above it, but it's declining. So are you going to get above this, or are you just going to sit there? We don't know yet, right? That's something you have to watch. Watch what happens here when we drop this to a 4-hour chart. Okay, here's your 4-hour, but let's get rid of the pre and the post for a second. All right, I'm already going sideways on a 4-hour chart. So let's drop that to the hourly. Okay, I'm already completely overbought on an hourly chart. So I've worked off everything on that hourly. And I'm not saying that you can't go higher. My life is a lot better when we go higher. But if I'm starting to look at these peaks, I'm more wedged in here than anything. So are we just working this off to go sideways for a while? And I'm sure everybody can just do something very simplistic like this and just drop that DTL right there and see it. So this becomes a crux. Now, why would I look at NVIDIA? Well, you can look at any of these names, but NVIDIA, obviously, as goes NVIDIA, goes the NASDAQ. We've seen that over time. Now, we could go here and take a look at Microsoft and say, okay, well, you did flip, and they are buying Microsoft, and you would be right. So for me, does it boil down to different sector rotation, and we have to start looking at the breadth, which is increasing. A matter of fact, the New York Stock Exchange breadth did hit all-time highs. So that is something of interest to us, right? All right, so we have the New York Stock Exchange hitting all-time highs. We have names like Microsoft above these control bars and getting above there. But the big thing is, are we going to have sector growth? Are we going to see these sectors lift? I don't know that we are. I mean, we've got declining 55 days. We're rejecting key levels. You start looking at this stuff again on the hourly, you're already overbought going into a key level. And then you start looking at some of these resistance points. Without the SOX, we have nothing. Okay, the NASDAQ cannot sustain itself without semiconductors. It's just a fact. You're going to get your APPs of the world that you guys are going to trade. We traded this one. We did exceptionally well with it. I'm not saying that. But this is not healthy, right? Like it's fun. It's fun. You can make money from it. But it's not healthy to just watch stocks just do that, right? Usually means short squeeze more than anything, which is really what I think we saw the other. I think that people were just out of position. But if you look at the SOX, and we go back to this on the hourly, which we're going to, and look at that and go, okay, well, all we did was rally back to a neckline and reject. And the answer is yeah. Now, are you doing that because of the Fed meeting or not? I don't know. And then you go and take a look at the XLF, and you're like, okay, well, I can't even get above here. I can't even get up. And all we did on the XLF was get, again, to what? Let's take a look at this. You got to this neckline, well, this double right here, and you flipped it and you held. But now look at what's going on here. And I think that people are missing this. And this is why I do like looking at these kinds of charts, okay? So when we look at this kind of stuff, what do I have here? Do I have a setup going into this? I wouldn't say that you do when you see what's happening with JP Morgan. We're going to spend some time on that in a moment here. So what do we have? What is the issue? Well, this is what I always do when I start to look at this stuff, right? I'll always go and see where the panic is and the fear is. And that panic and fear is in the XLE right now. Just straight up, it's in the XLE. We all know that. Everyone's panicking. No one's going to use oil ever again. You can see the sheer panic that's going on there. Now, what I like about this setup on the XLE is that when you start to see this kind of stuff, like this kind of panic, you can see a couple different levels here. What I like to do with these is I do like to clone them. And then after you clone them, you just see if they fit in somewhere. Isn't that something? Well, there's a Christmas miracle. So you came down here and you're at the low end of the range, right, where you're bouncing around. So you probably want to look at stuff like this. The other thing that I do tend to do here with all these indexes, and I'll just show you this, so that you can decide if you want to do it or not, is I look at this cloud, this Ichimoku cloud, and I just want to see what's happening with it. Now, there's a lot here that I'm not going to bore people with, but I'd like to make sure that I'm through something like this. Now, if I go sideways within a couple weeks, or even a week in this case, I would be through it, right? And that would be of interest to me, and maybe it would start to turn. But more importantly, when I start to look at some of these others, are we getting through them? And the answer is, yeah, you are. You are starting to flip them. But have they been definitive? Only when the trend's been definitive. For me, what I'm trying to figure out right now in looking at all this is, are we finally seeing some kind of bottom in some of these sectors so that we can get other sectors lifting the markets up and see some level of rotation? And the answer is yes and no. I think you're seeing it in some sectors that are looking like they're bottoming out, and others look like they're getting ready to roll. And that's where this gets confusing. Let's get into it. Now, this is really interesting, and it's definitely worth pointing out. But what you're looking at is the XLE Panic Breath Composite. And what this does is it shows extreme readings. So I want to go back to 10 years and just take a snapshot. And just to do this, the reason I do this is just to take a baseline. So not that we're going to compare anything from a decade ago, not in this chart. There is something that I do think is very troubling that we're going to get to in a moment. But so if I just drop this baseline here, and then we could just go, okay, here and here, just mark them off. Kind of gives you a sense of where you're at and how many times this happened over 10 years. And it's more than less, right? So it's not like it only happened like once or twice. I mean, it has happened a lot. And the good thing about that when it happens is you can actually go there and then have a data set. Now, I like 30 pieces of data before you start to say, okay, well, this is what it is. But let's drill into what we're actually looking at when we say, okay, well, we're over this 60 line and what happens when we're over 60. But what I want to point out is it's not like it's happened once, right? Or it's happened twice. 3 times. It's happened over and over and over again over the 60 line. But let's talk about what we're looking at. So one of the biggest pieces of value that I can add right now is this. If you don't know what you're looking at and you're saying, oh, this is the MACD, this is the RSI, and you don't know how they're calculated, you don't know what you're doing. If you know how they're calculated, then it's actually telling you a story. And that's the most important thing that I can tell you about what we're about to do so that you understand what you're really looking at. You want to know how things are calculated and then what they're suggesting it represents. You might find out that it's something else. In this case, I do tend to agree with it, and I'll show you in a second here. But if we look at the Panic Breath Composite, unique perspective, the market sentiment breath analysis, providing traders and investors with valuable overall market health. It leverages straightforward yet insightful formula information to gauge market participation breadth. By amalgamating these metrics, normalizing them into a composite score. So what are you doing? You're taking the overall market health and you're looking at it to do what? To gauge the market participation breadth. The Panic Breath Composite provides a comprehensive snapshot of sentiment, panic-driven behaviors. The composite index divided by 8 for normalization purposes offered a nuanced perspective on market dynamics as a valuable tool for assessing market breadth and identifying potential inflection points. So what they're looking for is inflection points where the panic is too much or obviously the excitement is too much. And you can see this when you see this panic indicator at lows versus when you see it at highs. Right, like for right now, just for point of reference, utilities is at like an all-time low. Like no one is even remotely concerned about utilities. Now let's shorten the time frame down that we know what we're looking for. It's determining the market breadth, and again, all we're going to do is just quick snapshot here and just take the 60 line and drop it down over 5 years, and the picture to me starts getting a little clearer on what you should be viewing here. To me, it does anyway, and you might feel a little bit differently about that, but marked over and over again. And some of them are going to take a little bit longer. Obviously, it's not going to just ring a bell. But you can see how this, anytime over the 60, tends to kind of mark a bottom in XLE and these energy names, doesn't it? And again, I'd like to drill down into these. Now you're just looking at 3 years and going, okay, how many times have we really been here in that 3-year period? Again, this is Sentiment Trader. This is not something that I created. But look right here. I mean, but wait, there's more. But if you take a look at these areas over and over again, does it mean you're going straight up? No, but I think it means that you're washed out. Where do I think you go with this? I think you can go a couple different ways with it. First, we can note exactly what's going on. We can note that this is the first time in a year that you've actually been up here. Did this area help you in August? Kind of did, didn't it? So are we going through something similar here? Maybe. Do we know for certain? No, we don't. And we don't know how long it lasts either. But we do know that is this the spot where we should be shorting? You'd have to look at that and say everybody and their sister right now is panicked, right? You have more panic on energy now than any time that you've had in the past year. Okay. And one of the fewest times you've had panic in the past 3 years, as we just went over. So is this really the time to be shorting it? No. Okay. So we can establish some kind of baseline here, right? And that's what this data does. So if we're looking for short ideas, which I think I have a great one I'm going to go through with you, or at least have a metric you should be watching because it did very well in telling you what was going to happen December 2007. And again, before I get into that, understand this is all data. This is just, hey, this is interesting. It might be something worth paying attention to and seeing if it gets worse, not better. But if we take a look here at what we're seeing, this is an area where you would know, like, yeah, probably not the best idea to add to my energy shorts here. Might be a good spot to go looking at the top energy names that I have an interest in and seeing if I want to add or start positions in. But speaking of positions, it doesn't hurt to look at how institutions are holding themselves in energy right now. So hopefully you're getting where I'm going with this. This is all connected. In other words, let's clean that off. In other words, where I'm going with this is that's one piece of data. Now you might want to go to another piece of data and go, I really wonder what the gas oil futures and the current positions are at by managed money net long contracts. I wonder if they're long or short gas oil. And this is from Bloomberg. If you don't have a Bloomberg or don't have access to a Bloomberg, which a lot of people don't for a lot of reasons, I can go to a website that's free in a moment here and just show you how to find this. But if we just take that 15 level and we just drop a line there, you're going to see that net long contracts combined of gas and oil through ICE are at what? Pretty much the lows. Now, let me show you a website you can go to and you can find this stuff for free. So the site in front of you, you can see it already, but right here, this site's called Macro Micro. If you play around with it, you'll be able to figure out how to get this stuff. It's really not that hard. But what we want to focus on is, okay, so it's the same exact data, and you can see your line right here, and you can kind of see where you're at, right? All right. Why is this important, right? Why is this important? And they compare it to the ICE gas oil price, right? And how that's going. And you can see that it's dropping down. I mean, it's not rocket science, guys. If people are net short something over and over and over again, or are not as much net long, then they're selling. The question is, does this get to here from here? I don't know. We had panic here. We were watching people fall down. It was a really scary time. There's something to be said about panic, right? Are we at that kind of panic level? And, that might be a good idea, actually, for us to go back and take a look at that graph, just so you can see the difference here. And you can see that right here. You can see the panic on that graph right here, right? That's pretty much ultimate panic. So are we going to get back to that level on that gas oil? I don't think so. You never know how this is going to play out, but I don't think so. But what this does for us is when we look at something, again, macro, micro, and you look at this, you can just kind of go, okay, well, a little bit bigger. There we go. Whoop, there it is. It is something you want to pay attention to and go, okay, well, no one's buying this. I mean, we're at the lowest levels ever. Does that mean that we're going to miraculously bounce because we're at the lowest levels ever? Ever? Wow, that was a weird word. But do you have any chance of bouncing here because of that? I don't know. If you thought you were going to bounce here because you were at lows, did you bounce? No, right? But you can see how this coincides directly with that panic, right? What you could do is you could look at the disparity here, right, and where they are net short versus the spike. For example, you could look at this spike and that spike and say, okay, well, we are higher here than we were here. So that does correlate with that net long position and how they are positioning themselves. So you're taking more data and just correlating it with what's going on. And then you're looking at the XLE in the same breath and realizing that it is all correlated. Again, does this mean that you're going to miraculously lift? No, but it does mean that if you were interested in some of those names, this might not be the worst time to just start seeing how they are going to do. For example, if I was interested in Exxon, let's say, one of the things that I would do, might be start looking at this and going, well, isn't that interesting that we held here? Why I bring up Exxon out of all of them is because Exxon hasn't missed a dividend payment in 40 years. This is a really good time, guys, and you just might want to write this down and go back and look at it. Just Google dividend aristocrats. You will find the most conservative names out there that have been paying dividends over their lifetime. So something like Exxon, it's I guess not funny story, but when people would call me, and like everybody wants to call somebody they know is in the stock market when this is happening, right? And people are like, well, what do we buy? The number one name I told people to buy was X. And the reason was they were getting 11 or 12% here on their money. And I'm like, they never miss a dividend payment. They haven't in 40 years. Exxon Valdez, they haven't missed a dividend payment. And you look at this and people are like, oh no, you should have bought Apple, you should have bought this. Well, the whole time you've been getting 11%, 12% on your money and you're up 5X, 4X, 5X, something like that. Some of this stuff you kind of have to start thinking long game, right? I mean, it's only 344%. And people would say, well, you got that with Tesla. Yeah, but where's Tesla in 10, 20 years versus something like an Exxon? Oil's been oil forever, right? And I'm sure we get a lot of comments on that. But, Okay, this has been around since what, the 60s? So let me know how that goes. We all know technologies change, and who knows, someday we'll probably have wings for all I know. For now, what I would say with names like this, I do think that this is an interesting time to start looking at names that are paying those kinds of dividends, that have that level of consistency, and might be hitting levels of areas of interest that seem to be bouncing when other things are not. Just a thought. Another name that's really interesting to me here that I like to pay attention to is Oxy, but I think he's got some issues. I don't know how deep those issues really are when you have that kind of money. I'm going to point them out anyway and get into it, because I think it is a bellwether that you have to look at and see what's happened. But if we take a look at Oxy here, for example, I like this a lot because I know that I have Warren here that wants to own the company. I mean, he filed back here to buy 50% of it, and every time we've gotten to this level, we've had a net buyer. Right now he could just be taking his foot off the gas and just letting it fall down and seeing how cheap he could get it. I pretty much think that's what he's doing. So this is one that I really like buying. I do have issue with certain names though. When I start breaking that 200 and I can't really get above it and I keep fighting it, it's not groovy to me. And it's also this makes it less groovy when I have something like this where I start having these death crosses. I'm not really feeling it, right? It's different if I'm going sideways. Let's make that yellow because that yellow makes me happy. So you can see how you're declining here. I really don't like buying things that have a declining 55-day moving average. It's one if I'm over it and I have the ability to like lift. But when I start breaking it, I can't get over it and I'm fighting it. Even when I'm basing, which this thing is doing, it does bother me. It does cause me angst. So why go through that? Why deal with it? But this is one that I'm looking at. But I do think that the Exxon also makes a lot of sense based on what we're going over. I think the one thing that you would look at is you wouldn't go here and go, okay, now's my time to buy, drip. This is probably not the time to go out there and start shorting energy or the oil names. I think that is the one key. People always say this in the comments. Okay, what do we do with this data? Well, that is the one thing that you would take away from this. I'm going to give you something else now that I think you really need to pay attention. Now, in my opinion, Berkshire is probably one of the most overvalued stocks out there right now. And I've been talking about this for about a month and people are like, oh no, we love Uncle Warren. And I think that's fantastic that you have a love affair with him, but there's more to life than that. There's something called reality. And when Berkshire is trading at this level, it did this in December 2007, something very similar. It didn't go very well. And so I think it's important to point it out, and I think it's important to show you who's actually selling Berkshire stock. So when we see something like this and it rallies up and people are like, oh, I'm going to buy it because it's Berkshire, you need to know what you own. And that's something that's really important for me. It always has been. And it stemmed from getting crushed in 2004 in something where I got hammered. Not understanding something, hubris, it does happen to all of us, right? But when I look at something like this, can I get back to this level and hold there? Maybe, but I think you have to just take a step back and go, well, what is Berkshire? All right, Berkshire is a company that owns other companies, and therefore all those companies can be valuated, meaning we can go through and determine the valuation of this. So to me, when I look at something like this, what should a premium be for buying Apple through Berkshire? What should a premium be for buying Bank of America or Coca-Cola through Berkshire? What is that premium that you would assign to it? Is it 10%? Is it 15%? And this is where it gets interesting. So this is price to book value of Berkshire right now. And right now, Berkshire's book value is 1.67. That means that if you go out there, and I did 20 years, and I did 20 years on purpose, but if you go out there and you buy, let's say, Apple, and you're like, oh, I'm just going to buy Berkshire because Berkshire owns Apple, you're actually paying 67% over. People say, well, that's not the way to figure it out. It's exactly the way to figure it out. Bank of America. That's what you have to realize, that's what you're paying over. Coca-Cola, that's what you're paying over. Someone's going to have to explain to me in the comments for what reason that you're buying those companies for this, and also why you're paying 67% more for cash. It makes zero sense. Now, the interesting thing about this is there's always been a baseline for 20 years where you pay a premium for the privilege in being in Berkshire Hathaway. And I think you could look at that and say, I'm willing to pay him 20% to manage my money because that's what the street pays the top hedge fund managers in the world. And that I get. So if I look at the baseline here, which I did, 1.2 to 1.25 is pretty much your baseline over 20 years. That's really the average baseline of the number. You are welcome to go and do the calculation yourself. Some people say, well, over 10 years, it's been 1.31. That's fine. I think you need to take a baseline approach to this. But for me, I get I will pay you 20% to manage my money so I don't have to deal with it, and you're doing better than I'm ever going to do, right? He's killing it. He's made great investments. That's not what this is about. What it has to do is, what are you willing to pay for somebody to do that, right? For example, 50% in Apple. What was the single greatest profit anybody's ever made in history on a trade? Was that size of that trade. So to be a party to that, are you willing to pay 20%? Because he had access, he was able to keep in that name. No one's doubting that. No one's saying that. What I'm simply saying is, are you willing to pay 70% or 67% to somebody to manage your money? And the answer is no. No, you're not. So why are people doing it? Well, the answer is they're not. Even insiders are not doing it anymore. And what I want to do is I want to point something out because it's worth pointing it out. Here's Berkshire in December 7th, 2007. The last time we were up in this level or anything over this level was December 7th or December 4th, 2007. Okay. I think that's really important to note. And the way that I always look at something like this is going, okay, versus valuation, where would you buy this? Well, when it got back down to like a 1-2, or if this ever got under book, which is really rare. I think there was a time that it actually did. It was like 0.91. Well, that's ridiculous. Because would you pay a discount to have him manage your money? And the answer is, of course you would. But when you start looking at like December 4th, 2007, is that where we're at? Is this what we need to concern ourselves with? I don't know. I have some really weird data that I do want to go over some of it with you. I don't know. I don't know. But I think that this is worth pointing out. And I want to be clear. I've said I don't know 3 times on purpose. So please don't tell me I'm calling for the next great financial crisis. I'm not. I find it very interesting that you're sitting up here. And I find some other stuff pretty fascinating that's going on too. And we'll get to that. But what I'm trying to do is I'm trying to, with this video today, is I'm trying to do 2 things. And for those that have been watching these for some time, you know that I talk through this when I'm doing. I'm trying to give you an ultimate macro, longer term thesis on what I see going on there. And I'm going to give you some micro stuff too that I think is how you need to start viewing the market. Because that's what's working on trading. When I look back at our community, what worked this week, it was super micro development ideas. And I'll get to that. But if you look at this, I think you're a fool if you're not paying attention to this and you're not looking at who's selling. I don't think there's a nice way to say it. So if we look here, this guy is the vice chair of insurance operations at Berkshire. And he sold more than half his stake in the company. This guy, just for point of reference, and we're going to get into it, this is from an article that got picked up nowhere. It was in the Hindustan Times. I go through a lot of news. I have people that actually help. I've been doing it for years. I find it very valuable. But if I look at something like this should be like front and center in everyone's paper. Guy's been with the company since the 80s, selling half his stake. And this is like, it gets even more bizarre to me. And I don't know another way to say it, but insurance operations sold 139 worth of Class A shares of Buffett's conglomerate. All right. And if we look at this, one of Buffett's top lieutenants disposed of 200 Class A shares for $695, right? Top ticked it. All right, cool. According to the regulatory filings on Wednesday, disposal long-term executive left control of 166 shares, 61 which he directly controls. Let me just explain this. He probably has some in a trust for tax purposes in his estate, which totally makes sense, just so you understand why that differs. But this is where it gets really interesting. So the executive joined Berkshire in '86 to work on the conglomerate's insurance operation, which include car insurer Geico. The move marks a shift who added 50 Class A shares in his holdings between March 23, and you're like, oh, well, he's just trading it at March this year. Okay, the move marks a shift, 23 and March this year. Okay, so this guy, just so we're clear, has been buying shares in the open market for the past 12 months up to March. Okay, please, the devil's always in the detail, guys. March 23 and March this year. So what he's saying is something between March 23 and March this year made him decide to get out. Now, he's got Class B shares selling more than 70 shares. Right, okay, so he doesn't want Class B, Class A, whatever. I don't care. But what I do care about is a guy that's been with the company since '86 is now blowing out the stock that he bought in March. Like, that's not what you do if you're at one of these companies. You don't whack your stock around in Berkshire. Like, that's not the game plan. The game plan is you're trying to stay in there for decades, right? There could be a litany of reasons that this is happening, but I find the timing very interesting, specifically with what you see Buffett doing with his positions. And I want to be really clear about this. I'm not suggesting anywhere that he's going to go through something like Uncle Carl's going through. I don't think that we're going to see Berkshire find out that Warren's got these loans out there, and my man crush is destroyed. But I don't think that that's what we're going to see here. I think what we're going to see is I think we're going to come to a baseline. And where that baseline is going to be, I don't know. I do also find it interesting that if you look at Berkshire, you've never had a day that's up since we peaked. So we go to September, we haven't had one day in September that's green. That's really weird. Like weird. I don't know another way to say it. That's the technical term we're going to use. Weird. If you have a better term than weird to describe this, I'm all ears. But if you start realizing that you have not had an up day since here, I think that that's worth paying attention to. If you look here on a weekly chart and you want to get technical with it, that is a complete utter rejection of taking out the high reversal and now you're heading down. Do I think that this is something that you have to pay attention to? I do. Do I think that you're heading back to the 2007 levels back here? No. And you can see what that did to the drop back here in 07. We can just walk through this really quickly. And I'm not trying to make it the Berkshire show, but I think that if you don't look at something like this where you're like, oh, Berkshire got cut in half when this happened, and I think that you're not looking at something like this, I think it's a huge mistake. Huge. And I think that this is something that you need to focus on. Now, it could be estate planning. It could be because of a litany of reasons, because of age. There's a whole litany of reasons for it. I'm not buying any of those because you wouldn't have bought in March. Like if they came out and said, oh, he bought 10 years ago and he's selling, but why are you buying stuff that you bought in March that you got to get out of? You're not day trading, right? You're not buying this for 6 months. That would be exhausting. You buy this for years. Something happened that made that man want to get out of the stock. It could be the same thing that these guys are seeing here where they're blowing out of, Bank of America, right? Like Bank of America has yet to come back from that. And then if you start going through this, and like the Apple trade, is he right? Is he wrong? I think he's right. And we also start looking at these pyramids going on there. I think him getting out of the Apple and reducing his Apple was right. I think that if you really look at that iPhone thing, it was a disaster, absolute dumpster fire. I don't know if we'll have time to get into it. I think that if you're not watching Berkshire and what's going on there, I think it's the equivalent of not looking at what JP Morgan truly said the other day and why people are taking it out of context. People are looking at this recessionary comment thinking that it's hyperbole. It's not. We should probably talk about that next. Now, Jamie Dimon spoke at a conference the other day, and I want to be really clear about this and my stance on this guy, and so just kind of on the same page here. This is a guy that basically was fired from Citigroup, and I don't know how many people know this guy's story, but this guy was fired from Citigroup like way back, like way before this, right? And he was supposed to take the helm of Citigroup, and he was fired. He went to this little bank. And then from that little bank, he came here and he actually had that little bank do a reverse mortgage by JP Morgan and then rose to the heights of becoming CEO of JP Morgan, which then became pretty much the biggest bank in the world with $3.4 trillion in assets. You don't do that if you're dumb, okay? It just doesn't happen. All right. So when the guy speaks, you need to listen. A lot of people will say, oh, he's just trying to, do this or he's trying to do that. He's just trying to get on camera. Zero interest in that. I would argue that the people that are taking his comments out of context are trying to get you to click and like his comment. Therefore, they can get some kind of, I don't know, maybe dopamine hit off of their Twitter feed or whatever. But when guys like this speak, if you don't listen and you just blow it off and you don't understand what they're actually trying to say, you're doing yourself a disservice. I think everybody needs to take a look at what's going on. And the more I'm doing this video, the more negative, embarrassed I think I'm sounding. I'm not. What I do is I look at everything and then I make a decision on what's going to happen. Now, we still have to get into the interest rates and all of that for next week and the micro view, but you need to understand that. You're going to do yourself a disservice if you don't look into what was actually said and you just go, oh, well, the tweet said this. Okay, good luck with that. Let me know how that goes. If you look at JP Morgan and you look at how this is acting since the Ally news, and for those that don't know, let's just do a quick recap on what's going on out there. And the Ally came out and said the CFO was at a conference, said the consumer has some real issues going on. COO reiterated there's some real issues going on. And this is what you got. This is what happened, okay? I think that is a real issue that is being blown off and you have nobody really doing anything there. Wells Fargo came out and said, yeah, we had some regulatory issues, but we're going to pay this fine and, it's all good. Well, why do you have regulatory issues again for the 100th time? And why did you feel the need to bend things to your will? Because couldn't you make money other ways? And that could mean that they're masking something. Now, that's a real big stretch. But that is something you have to think about. So then if I go here and take a look at Wells Fargo here on a weekly chart, does that look like something that looks good and should make you feel warm and fuzzy? No, I can't get above that level and I can't stay above that level. Matter of fact, I tried down 1, 2, 3. I understand it's 4. Up, huge red bar down. Boom, breaks. Okay, if you're in the community, you already know these patterns. You already know what they signify. So it's very bearish, especially at core levels. So, all right, so you have that. And then you go here and you look at XLF. And you go, well, that looks just fine. Yeah, that looks fine till it doesn't. And again, I'm not saying you're heading for this big financial crisis. What I'm saying is that you're not connecting the dots and you're not looking at this, you're doing yourself a disservice because you don't know where the puck's going. You're going to think that you should be buying the XLF names and the KRE names and not understanding why they're getting completely destroyed by XLRE and why commercial real estate is probably going to be like the biggest mover next year, right? People don't even understand why that's doing what it's doing because they're too busy, right, looking at the other stuff, okay? So what I'm trying to do is give you an understanding of how you should be trying to connect these dots and look at what's going on under the hood. All right, so here's financials, and people go, well, that looks just fine. How long is that going to stay like that if JP Morgan looks like this? Okay, when you start going out there and going, well, JP Morgan just closed at a level that you haven't seen since July, okay? Do I have a problem here? I think you have a situation that you need to monitor, and I'll leave it at that. And I'll show you what he said, and then we'll go from there. But I look at this H, and that is troubling. And this is from somebody that was actually long, bought the dip in some of these names, and candidly blew them out, and then took the other side of the trade and did okay with the other side of the trade. But I have a 55 here. I can't get above it. And this is what bothers me about that. And I'm going to just point it out. So if I get rid of this and I zoom out, I will see that for this year, we have been below the 55 on a couple different occasions. Number one here, 1, 2, 3, 4, and then we pop over. Down, pop over. What got us up here was what? Earnings, the shake and bake, and then they lifted us back up. Okay, here was what? Okay, this was the move down. Why? Okay, we have a whole Japanese yen issue we need to discuss that people are pretending it's not happening anymore. We'll get into that. But if we look right here and we look at this, I broke, tried to rally and failed. I broke, tried to rally and rallied. I broke, tried to rally and rallied. I broke, tried to rally and rallied. I have a very different situation going on here right now. Now, I'm not saying you're going to stay here, but from a technical standpoint, until you're above this 55, I think you need to be suspect and try to figure out what the heck is going on here. And I think there's more under the hood with what we saw with Ally and some of these other issues. And I'm going to tell you what I think it is in a moment here, but let's actually look at what the guy said instead of looking at a tweet from Freddie Fingers as to what he said. So this is what's got everybody like in a tizzy. Oh, he's just trying to paint the tape. There is an outcome worse than a recession. It's not a depression. Okay, so let's just get that out of the way. What he's afraid of is it's called stagflation. Okay, and it is bad. And if you hadn't lived through it, that's fine. But you know what it is. If you don't, we're about to explain it. Worst outcome for American future is not recession. The worst outcome is stagflation. And by the way, I wouldn't take it off the table. And I think he's right for saying that. All right, so let's talk about what stagflation is, and we'll go from there. 68 told remarks counts of institutional investors in New York. He's actually speaking October 23rd at the JP Morgan Robinhood conference, and you might want to mark that down as well because that's in like 4 or 5 weeks, and that will move the market usually when he speaks there. JP Morgan is the largest bank in the US with a 3.4 in assets. Stagflation and inflation refers to a state where economic growth slows while inflation and unemployment rise. All right, so let's talk about this, okay? And why is he saying it's not coming off the table? So what is stagflation, and why does he think that it's not coming off? All right, well, let's get rid of my fancy lines here and go, okay, well, stagflation refers to economic growth slows. All right, do we have economic growth right now? No, we don't. Is it slowing? Yeah, it is. Okay. And inflation and unemployment rise. Is inflation rising? No, it is not. It is dropping. Okay. So we have GDP that's coming down to flat. Okay. And we have inflation that is not rising, it's dropping. Okay. So we don't have that. Is unemployment rising? Yes, it is. Okay, so unemployment is rising. Not a lot, but it is. And we're losing jobs. And we've seen that on the non-farm payrolls being a disaster, right? They just changed the number after about a year, took away about 1 million jobs. So we know there's a problem here with unemployment. Okay, and we know that they're masking it. We know that. So we know unemployment's rising. We know inflation's dropping. So do we have all the parts of stagflation? No. Okay. Do you have some of the parts of possible stagflation? Yeah, you do. Okay, well, what parts of stagflation do you have? You have a GDP that is flat, right, to going down. Okay, so you have one part of stagflation. Okay, what are the other parts that you have? You have unemployment rising. Okay, so the only thing that you need for stagflation to actually happen would be for inflation to pick up, which frankly, I don't see happening, and I don't see stagflation happen. And I think that he even assigned a percentage to it. The economic consequence causes retirement savings to go down, the stock market to crash, blah, 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 blah. Everybody be scared. Okay, according to CNBC, from August, Dimon believes stagflation future is likely around 35%. Okay, so he's saying there's less than a coin toss that this would actually happen, but you can't take the risk off the table. See, what these guys do, all the big guys, they assign percentages to things, okay? And he does think that you can see signs of recession. I could make a very solid argument here that we've been in a recession, quite frankly. So I think that this is something that you have to consider and look at, but to blow it off and say, I'm not going to pay attention to it because it's hyperbole, and he's just trying to get in the headlines. Believe me, these guys don't even want to be in the headlines. So if you see something like this, I would look at the chart. And this chart to me looks eerily similar to something else. All right, now in front of you is the US dollar versus the Japanese yen. Okay, that is on the bottom here. Now I'm going to pull this down and you can see that very clearly how we are mimicking what? JP Morgan. I mean, it really doesn't get much clearer, does it? So the next thing that we could do is take a look here and throw in the S&P and just drop that in as well. And this is where it gets what I'm going to refer to as weird. And what I'm going to do is I'm going to get rid of these lines. I'm going to make them candles. And no, I don't have time to edit all this out. And I don't care if you think it's getting cloudy in there or not. Look at this and look at the difference here. And why did this happen? And why do we have a reversal? And why is this not mimicking that anymore? Okay. I find this very troubling to some extent. And the speed at which this happened to me was pretty troubling. And so was the breadth of what I saw happen. And I'll explain that in a minute. I'm not crazy about this and how this happened. The undercut and then the rally in the S&P and then from there. Now, if I take a second here, and this might get too crowded, but we're going to do it and we're going to see what happens with it. This is the other thing that I found really troubling. And people are like, no, it was great. You know, it's all good. Okay. So that mimics exactly what? If we look at this for a second, and if you're too confused, I'll just take that off for a moment. And what do we have mimicking here? Okay, almost to the T, right? I mean, like it's almost exact. You have the S&P and the NASDAQ moving in tandem perfectly together. And at the same time, you have this entire Japanese US dollar trend. And I think that's an issue, that you have a divergence. Now, the question is, why do you have this divergence? And why should I just pretend that it doesn't exist? And why should I no longer care about the Japanese yen trade? I would personally suggest that if you don't care about this trade, and what I'm going to do is just take the NASDAQ off now, and we're just going to look at this and go, okay, well, has this trade been following itself for a period of time? And, you know, let's just go and take a look at this and go, well, have we followed any kind of pattern? And we would say, yeah, I think we have. And go, okay, well, we're going to go back 12 months and just see. All right, so in November, when we said we were going to raise rates, or raise rates are done, right? Remember, Itchy said no more rate hikes. And then at the same time, we dropped. And then after this dropped, after no more rate hikes, we went higher. The question is, are they saying no more rate cuts? And because no more rate cuts, then we're going to go higher again, which is the equivalent of the same thing here, even though this is going to drop, right? See where I'm getting at? So in other words, this dropped for a period of time versus this rallying up. So in other words, this being the US dollar, Japan was dropping. But at the same time, we have the S&P going up. And then after a couple months, it adjusts and the correlation begins again and the cycle of life is complete. All right, is that what's happening again? I don't know, but is this an adjustment here to this? I don't have a clue. What I do know is that this is a complete divergence off of what we've been saying in regards to the market for the past 12 months. You have this divergence here based upon Fed activity that reset itself from January on, where you can almost set your watch to this, meaning on that July 11th, when we had the negative CPI month over month right here, that marked the high of the market. That was your high on the market. You'd never come back from that, ever, okay? And I think that's really important to also note that. And I'm going to just drop this here so that you can see what's going on, right? That level has yet to be breached from the date of that. And all the US dollar yen trade has done is completely implode since that day as they rose, right? And they raised rates. All right, so what does this do for you? How do you benefit from this? You have to look at this and have two schools of thought. Number one, are we going to go through a period of change like we did here when they cut rates? Yes or no? Don't know. I don't know that. I know that this is troubling, and I know it's troubling to me that it's following what JP Morgan is doing. I know that we just took out the lows of this move, and the market is not taking out those lows. So Are we going to go on the theme that the trade's just unwinding? And if we're going on the thing that, we just unwound and therefore that's why the extreme move, because it was a technical drop, therefore it's not going to affect the market the same way. Okay, that's a heck of a thing to try to figure out going into the Fed next week, isn't it? And I think that that's to be on your mind. I do think that you should be watching this yen. I do think that you have to go on the assumption that, hey, did we just possibly, for example, if we were to look at this, did we just possibly put ourselves in a position here where all we did was just rally because we were oversold? Is that what happened? Because we really haven't done anything great here, have we? I mean, what did we really do here that was so fantastic? I mean, it was cool that we went up. It was easier to make money. But if we take a look at something like this and we watch the bounce, did we really go anywhere? Well, you didn't make a higher high and you didn't make a lower low. So you didn't really do anything except stay in a trading range ahead of the Fed. So, okay. And then you go look at the SPY and go, well, what did the SPY do? Well, we didn't make a higher high, right? And you didn't make a what? A lower low. Okay. So then let's go back out to the weeklies and take a look at the weekly here and go, all right, well, we're still below, fine, whatever. We can straighten that out and go take a look at something like rate of change and say, are we back over or not? Okay, so again, all we're trying to do here is connect the dots. That's all you're trying to do here, right? You're trying to look at the market and try to find some semblance of something that makes sense. There's really nothing else to do with the market except try to do that. Nobody knows what's going to happen. I'm sure you'll find some channel and the guy's going to be like, oh, I know exactly what's going to happen. He doesn't. So here you are. All right, so the rate of change is going back positive and you reversed. You could not have a better scenario for us than not going lower than where you were. So the SPY held, okay, and then you look at the Qs and you go, well, the Qs are not above the zero line yet, but they are starting to turn. Okay, well, that's good. Rate of change tells you exactly what it sounds like, rate of change over the previous week, right? You don't want to be below the zero. But what you are saying is saying, okay, well, it is possible going into this that we bottom. So then we have to go on that theory of going, okay, well, if that's the case, and if we did do that, and if we did bottom, right, the market can only bottom if rate of change goes up. I mean, it just makes sense if you think about it. You can't go higher if the rate of change is not positive. It just can't happen, right? It's not rocket science. All right, so we have this and we understand that. Okay, so now we have a possible bottom on the rate of change, and we know that the US dollar yen carry trade that we're watching and concerned about in relation to JP Morgan, we know that we tie all that together, and we know that we had the divergence in November when the Fed spoke. So we understand that we could have another one now, and we also understand that we need to watch what's happening here with rate of change on the weekly. Okay, see how you connect all this and you're looking at it and trying to make a decision? Now, at the same time, look at the daily. Now watch this on the SPY. Look at the daily, okay? So what is this telling you? What is this telling you? It's telling us that we tried to rally, and so far on the daily, I can't get above the zero line on the rate of change. How does the market go higher if rate of change is negative? Do you want the answer? I'm sure you do. I'm not going to keep it suspense. You don't. Okay? You can't go higher if rate of change is going negative. If I'm here and the rate of change is dropping, the market will not go higher. It's called rate of change. If your rate of change is dropping, you can't go higher, right? Don't overthink it. It's really that simple. There's a reason why it looks like this, and all you're using is the zero line as a demarcation line. All right, really important concept to get. And this was something that I looked at on Friday and said, okay, I'm going to start locking in some trades because I don't know what the heck's going to happen here. And this to me is a telltale sign. I'll give you some more telltale signs that got to me. When you see names like Costco at the end of the day that look like they were ready to break out and everybody had to own them, and you're watching retail buy them all day, and at the end of the day, you're watching them getting sold, that becomes an issue to me. When I'm watching things like MO, right? Try to rally, and they are, but watch. Okay, and this was very troubling to me. See how this got up here? This was a trade that we were in, and then watch what happens here. We're starting to break the 22. You're trying to hold here, and maybe you do. And we're going to get into why I think this has happened, and why people are looking at TNX and not understanding, why did we rally the other day? But watch PM. If you look at PM, you came out and raised your dividend and the stock. Okay, you need to start paying attention to the area that I think has the most potential, in my opinion, is going to be some of these micro trades, but it's also going to be the trades that are going to benefit the most from interest rates long term. And let's take a look at that. Now, for time's sake, I'm going to go right to the site. It's going to be easier for me to do this. This is CME Group. Anybody can do this. It's free. You'll note that I try to give a lot of free sites on here. You have a coin toss, my friends. September 18th is coming. Right? They're going to cut. Are they going to cut 50? Are they going to cut 25? I'll give you my opinion. They're not going to admit they're wrong. Okay? They're just not going to do that. How would they admit they're wrong? By cutting 50. it would mean that Powell once again missed something. Shocker, I know. But I don't think they're going to do 50. I think they're going to do 25. What this is telling you is that you're going to have a massive move because someone's going to be wrong. Someone's going to be betting 50. And again, for those that don't know how to use this, the current target rate is 525 to 550. And you'll see 500 to 525 here and 475 to 500 here. And then if you're taking a look at this, what this is going to tell you is very simple to me. To me, it's very simple. Someone's going to get hurt, okay? And that was my reason. Like on Friday, I looked at this. I took a lot off the table because I looked at it and went, I have a coin toss. Does it look like there's any edge to this whatsoever? No, it's a coin toss, right? And this is institutions betting on this. So they go out there and buy these, these target rate derivatives. But all right, so if I see this and then I go out to November and I'm looking at it and going, there's a 50% chance that I'm here by November, and there's a 27% chance I'm here, and there's a 23% chance I'm here. So what is that really telling you? Well, it's telling you again that you're still in this kind of coin toss kind of area, right? Maybe you're leaning more this way than you get in December. And you're like, okay, well, again, if you really look at this, how much are you shifting? Sure, you're shifting more this way, but what's really happening? And I think that that's the problem here. I think that if you really go and take a look at this from 1 week ago to now, any data that came out really didn't change any of the numbers. Go take a look at November, right? You really didn't move the needle that much from a week ago. And I think that that's what's scaring people a little bit. When you look at this, they're like, okay, well, a week ago we were at 70-30 and now we flipped to 50-50 going into this. But November and December really didn't change. After what? CPI, PPI, like none of it changed, none of it. So when you start to understand this, this is why I think that you could even see bonds sell off on Wednesday. I think you could actually see yield investments sell off on Wednesday. I think what people need to do is think about if they sell off, who's going to benefit the most? And this is where it gets interesting. This is where I think I could add value. So the people that are going to benefit the most from this, in my opinion, are going to be utilities. They're the first ones that are going to benefit. Why? We need more power, right? I feel like Scotty in Star Trek, but like we need more power. Data centers, whether you want them, they're here to stay. They're not going anywhere. We're going to have more and more of them. We're going to need more power for AI. If you don't think that, I can't help you, but it's not going away, especially on the business side. Forget the consumer side. Again, there's two ways to look at AI. Chat GPT, Apple, which was a dumpster fire, Dell getting rid of what? Their PC department because of slow PCs. There is no AI PC. There isn't one. Someone show me it because it doesn't exist. Apple doesn't even have the software ready for their quote AI product. You have to buy the hardware and someday they're going to load the software in. Don't we all love those updates? I'm sure it won't be a problem. So if we take a look here and look at UTSL, which is the 3X bull fund, you can see that finally breaking out. You can see utilities breaking out. Everybody agrees on one thing. The Utes are going higher. Okay, and that usually means that the market goes higher. And that's why the breadth is so good right now in the market. So if we take a look at this, and the breadth is very good on the market right now on the New York Stock Exchange. It's actually at all-time highs. I'm not going to go through it for time's sake, but you can just go look at that yourself. All right, so the Utes are going to go higher. Certain ones better than others. I always just say, just go with the best, which is SO, Duke. They are the best, right? And they tend to just kind of grind. And that's all they're doing. They're stair-stepping up. If they dip, I think they get bought because there is demand for product. I think they're going to go with where demand for product. That's where my head is. And I'm not sure that's the Philip Morrises and the PMs of the world. I'm not sure of that. I know that we need more power. And I know that they're going to expand the power out and that this is going to grow. That's just a fact of where we are in the cycle. Is this kind of factored in? Does everybody know this? Yeah, and I think that that's why I still think that this is a good sector. I don't think it's the best. I think the sector that people are not getting at all is the real estate investment. When you start to look at these names and understand that people still think that office space is dead, I think there's a huge problem there. So if I look at something like HPP, which is in San Francisco and LA, and nobody really wants to, it's not business friendly right now, right? It'll change like everything. It'll get business friendly again someday. Okay, I get it. You don't want to look at something like that. Or you can go look at BDN, so people don't think I'm picking on, California, which is based in Philly, right? And yeah, they're starting to rally again, and their book, I think, is 7 or 9, something like that. Great. Yeah, they're starting to rally again, okay? And they're doing a little bit better because they're in a second tier market and they have exposure to Texas. All right. But then you go and look at something like New York. And we were all told that New York is dead, but if everybody remembers, if you've been watching these videos, this is where a Japanese firm came out and bought 50% of 245 Park for a very small percentage, right? 50%, they paid $2 billion for it. How'd that work out? Pretty well, right? So again, New York is not dead, but look at VNO. People don't even want to look at this and watch what's happening. These names are going to explode when they start cutting rates. And it's not all factored in. If you start to even look at like the data center names that are out there, did this get ahead of itself because everyone got giddy with Oracle's comment, right, on data centers and what's going on out there? Yeah. Same with EQIX. These things are always going to push. They're always going to get ahead of themselves. But this is the space that you have to look at. When you go look at something like Avicii, which does, they own the top 10 places in Vegas, and you start going, okay, well, that's kind of interesting, isn't it? Yeah, well, how's that doing right now? Oh, I'm at all-time highs. There's a reason you're breaking out of a multi-year base on XLE, or XLRE name, rather. And I think that you need to really take a look, very hard look at these. There's other names that I think that you could focus on too, and I'm just going to throw this out there on the micro side. So something like X, I think you should pay attention to this. If you're in the community, you already know this. We started buying it on this dip, and then we just married puts to it. I am going to do a video on it. It was more important for me today to go through how I see the world going into the Fed meeting, but and the risks that are there. But if I'm to look at this, Nippon had a meeting in DC, and at that meeting, nothing came out of it except the government said that they're going to kind of look more into this before they do anything. Okay, that is political speak for we're probably going to approve it if we're in after November and you vote for us. Okay, I mean, I hate to be that cynical, but that's pretty much what they're saying. Whether you believe that or not doesn't matter. The easy money was made down here. You got right to the neckline where CLF said they would pay for the company. If you're in here, which I am, I just marry puts underneath of it and leave it on for the upside. It either works or it doesn't, but you have to realize that now you're probably not going to see that to November. Another name that we did this week that worked out really well, and I would spend some time looking at this, and I may do more on this on Monday if there's demand for it, but SMMT. Look, they're threatening Merck's drug, okay? Merck's biggest drug is under threat, period. Whether people think that or not, 25 billion of their revenues, which is nothing is even close to this for revenues for Merck. Their phase 3 trial crushed that drug. Okay? You can just go read it for yourself. I dropped a lot of work in the community on it for those that are in there. But like, there's no way that someone doesn't look at this and try to get involved with this company, either in a partnership or just outright buying it. People are going to say that, oh, the stock's too high now, blah, blah, blah. What's it worth to own a company if the other company's doing 25 billion a year in value? Okay, I'm shocked that you haven't just seen Merck come out and just try to buy the company just to preserve so they don't have a problem or partner with them in some way. It's very odd to me. I think you have to look at themes like the XLRE themes, the XLU themes. I'm not telling you to not whack around the video if you want to, go for it, right? But you did reject some key levels there. What I'm suggesting is that you're missing the actual themes that are going on, that are going to be affected by the interest rates. And the other thing is, I would start looking at some micro themes that have some stories behind, right? And do some fundamental analysis, because there's a lot of money to be made in that right now, because a lot of people really aren't paying attention to that anymore. We got sucked into this one big trade, and sometimes this happens and you miss the forest. You're looking at the forest rather, and you're not seeing all the trees, and that can be a mistake. That's it.